Hi, I'm Mark Jokum, Product and Investment Strategist here at GlobalX ETFs, and today I'm joined by my colleague Stephen Parker, Portfolio Manager here at GlobalX ETFs, and today we're going to be giving you an update on the market, in particular to a product that we've had for a few months now, since July 2024, which is the GlobalX Bank Credit, Australia Bank Credit ETF, ticker code BANK. So really excited today to give you a bit of an update. We're going to be talking about the positioning of the fund, how it's performed. We'll talk about some of the regulatory proposal changes. And finally, just some thoughts that you might want to take into the new year leading into 2025. So Stephen, to start things off, as I mentioned, the fund's been around since July 2024. So can you take us through how it's performed since then and also the current positioning of the portfolio as well?
Sure thing. So in terms of how the fund is positioned, it's designed to track its index. The underlying index has a 40% exposure to bank senior bonds, a 30% exposure to bank subordinated bonds or Tier 2 debt, and a 30% exposure to hybrid securities or additional Tier 1 securities. The fund since inception has been tracking that index and thus been positioned accordingly. In terms of its performance, since its inception, it's returned about 1.5%. This is in line with our expectations and its current running yield of around 6%. And we're also seeing that the fund has had good growth to date. It's received about $25 million of inflows. It's definitely had some good interest out there in the market, and it's pleasing to see that there is that interest for a product like BANK.
Yeah, definitely. And I think also you mentioned the running yield of 6% in the current interest rate environment. We've seen bank term deposits actually fall more recently as well. So definitely an interesting and compelling value proposition from a yield perspective. I want to now shift gears to talk about some of the regulatory proposals that came out from the regulator APRA not too long ago. Can you give us a bit of a rundown on exactly what the proposed changes are, but also how this would particularly impact a product like BANK?
Sure, absolutely. So the proposal from APRA was, in essence, that they would like to remove or phase out the issuance of hybrid or additional Tier 1 securities. So they're not planning to do this particularly quickly. It's a gradual phase-out plan as the proposal is written, would have all the securities basically rolling off and finally there being no more of them by 2032, so some 8 years into the future. The main motivations for APRA proposing this to begin with was simply that for a long time the regulator has had concerns over retail investors owning hybrid securities. It views these securities as quite complex, and it has a general concern that the average retail investors that are investing in these securities don't understand all of the complexities inherent in them and the risks associated with them. So it's come out and proposed basically the abolition of all of them by the end of 2032. I would say this came as a bit of a surprise to me. I was expecting that they would come slightly less aggressive in some sense and just force the banks to issue these securities into the OTC or wholesale bond market and thus still not into the direct hands of retail investors. They've went one step further and just proposed the abolition in its entirety. In its place, under the current proposal, they would then have the banks just issue more subordinated or Tier 2 securities instead, or in the case of the 4 Aussie major banks, they would also get them to issue some more equity capital as well. In terms of these changes' impact on BANK, the portfolio itself, the first thing I would say is BANK is a full capital structure product. So since its inception, it had access to the entire debt capital structure of the banks, which is senior bonds, subordinated bonds, and hybrids. Obviously, if this proposal comes in and hybrid securities no longer exist, both BANK and its index will have to change to accommodate that. At this stage, we're still just waiting and watching to see what happens with changes to come if the proposal gets up.
And I think that's important to note. It is currently just a proposal at the moment, but the great thing about an ETF like BANK is it is diversified across the debt capital structure. So you're not taking siloed bets on each of those individual securities, and it will naturally evolve as per the index methodology. So Stephen, you painted a good picture in terms of the background. So now with a product like BANK, it's got a pretty attractive yield profile. Should investors consider actually switching away from something that they are quite familiar with, which is the banking shares or the equity side, into banking debt?
That's an interesting question. I would generally see that both bank shares and bank debt have a good place in an overall investment portfolio, so I wouldn't see it as you should have necessarily one or the other. They just form different parts of a portfolio. Bank debt, a product like bank itself, forms more of the defensive allocation in a portfolio with more of a focus on yield, whereas bank shares, bank equity, you have more of a focus on capital growth, still with some yield in those securities as well. It's interesting to note that between those two different asset classes, sometimes the yield of one is greater than the other and vice versa. In the present market conditions, it's actually in favor of bank debt, where the yield on senior ranking bank bonds is actually higher than you can get on bank equity. That's not always the case, but at the moment it is, which makes bank, at the moment more of a compelling product, I would argue.
Yeah, definitely. And I think it's important for investors to monitor that difference in yield or the equity risk premium, because right now with equity risk premium being quite low, definitely paints a favorable picture in terms of the current yield profile of banking credit as opposed to the shares itself. Final question, Stephen, for you is, what are some of the things that are either keeping you up at night or some things that are on your radar leading into 2025 that investors should have front of mind?
Sure. I guess there's three main things that I'm keeping an eye on, if you like. The first of these is the interest rate environment and interest rate decisions out of the RBA. Even in the 3 months that bank has been around since it launched in July, expectations of the direction of interest rates and the speed of hikes or cuts has actually varied. When it launched, a lot of people were thinking that the next move might actually be an increase to rates. These days, people are generally more thinking that the next move is actually going to be lower. As that interest rate expectations change, that can impact bank, notwithstanding the fact that it doesn't have a huge interest rate sensitivity because it has a lot of floating rate exposure, but that's still a very important thing that we're keeping an eye on. The second thing we're keeping an eye on is the general level of credit spreads. At the moment, credit spreads are quite tight. If we were to see a risk-off sentiment, there is certainly room for credit spreads to move wider. So that's something we're constantly monitoring. It's not something we're particularly worried about at this stage, but it's always prudent to keep an eye on it. And then the third thing that we're looking at is the aforementioned APRA proposal that we discussed, keeping a close eye on how that evolves. Does it get off the ground as written, or are there further changes? So I guess those would be the big three things that I'm looking at heading into 2025.
Lots of things to be on investors' radar. That's all we have time for today. Stephen, thank you so much for joining us and giving us your insights. If you have any more questions or you'd like more information about our bank credit ETF, ticker code BANK, jump onto our website or feel free to get in touch with us. Thank you for joining us.